5 common mistakes that new investors make when investing in the stock market. Mistake number 1 would be not understanding the difference between trading and investing. A couple of examples of trading would be purchasing a stock or an ETF with the intention of selling it prior to the close of the market on the same day. That type of trading would be called day trading. The second example would be called swing trading. And swing trading is essentially purchasing a stock or an ETF with the intention of holding that position longer than one day. Most people that swing trade will hold their position anywhere from a couple of weeks up until a couple of months before selling that position. When we talk about investing, we're talking about taking money that you don't need in the short term and investing that money into either a single stock position or into an ETF with the intention of holding that position for a long period of time. Now, everyone's definition is going to be a little different on how long they would like to hold what they would consider an investment. But in my opinion, and the strategy that I use is when I'm purchasing an individual stock or an ETF, my intention is to hold that position for a minimum of 5 to 10 years. And the only way that I'm going to deviate away from this position is if I have an individual stock and something substantial changes within that organization that would require me to liquidate my position. Mistake number 2 would be the lack of planning or research. So whenever you're a new investor, you want to make sure that you understand things such as the platform that you're using, whether that's something like TD Ameritrade, could be Webull, could be any available app that you would utilize to purchase a stock. But you want to make sure that you understand how that platform works, how you buy, and how you sell. And then secondly, you want to make sure that you are researching every position before you buy it. So when you're a new investor, you'll often have people that will come up to you and they'll mention stock tips or give you organizations that you should invest in. And I think that's fine. You should absolutely, listen when someone is giving you a tip, but you want to make sure that you're researching that position yourself prior to investing any hard-earned money into any position. So the main strategy that I employ for when investing is purchasing as ETFs. So one of the main reasons that I like to purchase ETFs is it takes the stock picking responsibility off of your shoulders and it puts it with a fund manager who is managing the ETF that you purchase. So one important thing that I want to mention about this stage in the process is that you can overanalyze and over-research to a certain point to where you get paralysis from analysis, and which leads you to take no action at all. So what I would recommend would be is to do your research, do your due diligence, have confidence in your research ability whenever you're making those purchases, but you want to make sure that you're making that first initial step, which is actually purchasing a stock position. Mistake number 3 is overreacting to market volatility. Now, this is something that you're going to have to get used to as you invest in the market. You'll start to understand that the market will go up and down, and that's something that it will always do, and it has done so over the entirety of the stock market life cycle. When investing, having the power of patience is going to be one of your number 1 assets that you'll need to acquire as you go along your wealth building journey. And you have to also understand that the market is often volatile and it will go up and down with the news cycle. So it's important to understand that investing is a marathon and not a sprint. And you're looking at this from a very long-term perspective, that 5 or 10 year period that you're going to continue to invest every 2 weeks, every month, or whatever cadence that works for you into this position. And you're going to be doing that for the next 5 to 10 years to ensure you're building wealth in the long term. Mistake number 4 would be putting all of your eggs in one basket. As a new investor, you may be tempted to put all of your money into a single investment, a single stock, and that is not the right strategy that you want to employ here. You want to spread that around and have some diversification within your portfolio. And you can do that by a number of ways. You can purchase numerous individual stocks, which is something as a new investor I wouldn't recommend that you take this approach. Or you can go through and you can purchase an ETF that covers several sections such as real estate, energy, utilities, technology. So there's a ton of different sectors that you can choose from to purchase an ETF to ensure that you are diversifying your portfolio to ensure that you do not have too much concentration in one investment. So if you recall that market volatility that we talked about, you want to make sure that anytime the market is moving up or down, you want to have your assets spread out to ensure that you're not risking so much in one single investment. And mistake number 5 is letting fear stop you from taking action. Fear, or false evidence appearing real, is something that we tell ourselves that literally paralyzes any movement that we want to make in any part of life, not just investing, but in life in general. It's something that's in the back of our mind, letting us know that something's not going to work out, or you're going to lose money, or someone that you know told you that their cousin invested in the market and they lost everything. Now, I can tell you there's no guarantee in the stock market that you'll make money, especially in the short term. But what I can tell you is that this process of dollar cost averaging and investing into ETFs and index funds on a monthly basis is the blueprint that has been laid out. It's absolutely the blueprint that's laid out. It's what we do in our 401k, and it's what many, many millionaires have done over the years to generate wealth. And that's why it's so important to look at investing as a long-term approach to building wealth. And just remember, fear is an illusion. It's a fairy tale that we tell ourselves to why we can't get the outcome that we want to get. By avoiding these mistakes, you can absolutely become a successful investor. So remember, be patient, don't overreact to market volatility, ensure that you're researching every position that you purchase, and most importantly is do not let fear stop you from reaching your goals. If you got some value from this video, consider subscribing, and while you're at it, smash that like button. Thanks for watching, and I'll see you in the next video.